On the 5th of June 2026, US stocks suffered their worst single-day rout of the year. The Nasdaq plunged more than 1,100 points, wiping out $1.3 trillion in market value. NVIDIA led the semiconductor sector as collapse and panic spread across Wall Street. Analysts scrambled for explanations. Was it Fed as reluctance to cut rates, or was the AI bubble finally bursting? But thousands of miles away in HSINHU inside TSMC's headquarters, an eerie calm prevailed. Just 2 days earlier, at the company's shareholder meeting, JRM and C.C. Wei, facing a room of anxious investors, delivered a single, understated sentence. I don't know where the demand peak is, but what I can say for certain is that for years to come, we still want to be able to satisfy all of our customers. This statement is the most brutal underlying logic of the AI era, whereas the world fixates on whether NVIDIA can sell all its GPU sets. The true king TSMC sits at the center of the table. It says little, yet every player must read its expressions. Back us is the physical limit of the AI industry has never resided in Seoul ICO and Valley's labs, it lives inside TSMC's fab sets. So why TSMC don't TSMC and Intel have a chance? To understand TSMC's monopoly, we must first refresh our understanding. Semiconductor manufacturing is not an industry, it's alchemy. Below the 2 nanometers scale, electron behavior no longer follows classical physics, it enters the realm of quantum tunneling. To put it in perspective, this is like precisely arranging tens of billions of ping-pong balls on a fingernail-sized surface, without letting a single one roll into the adjacent lane. In theory, only 3 players can compete in this race: Samsung, Intel, and TSMC. Samsung aggressively but perpetually one step short. That speed is stealing a march with early 2 nanometers production in early 2026. Massive heat dissipation issues and low yields market chatter suggests initial yields were just 60% of TSMC's sent Qualcomm and NVIDIA scrambling to shift orders back to TSMC. Intel's IDM model is both its strength and its Achilles heel by handling both design and manufacturing. Internal coordination costs are enormous. While TSMC's engineers focus single-mindedly on conquering physical limits, Intel's engineers are still fighting turf wars between internal and external clients. TSMC, a pure-play foundry, it doesn't design chips. It doesn't compete with clients. It does only one thing, betting its entire existence on process miniaturization. But that's not the whole story. The bottleneck for AI chips is no longer just about manufacturing logic chips, it is about packaging. NVIDIA's B200 chip stack 2 GPU dies and 8 HBM memory dies together. Size complex 2.5D 3D heterogeneous integration. Core OS technology, over 90% of global capacity is controlled by TSMC. If you don't have TSMC as Core OS capacity, even the most brilliantly designed compute chip remains nothing but a lifeless piece of silicon. We've been working hard to expand capacity, but even after our Arizona fab begins volume production, the global shortfall will remain enormous. Si's end-to-end chokehold from process technology to packaging gives TSMC unparalleled pricing power. In Q1 2026, TSMC's gross margin hit 66.2%. SiS means clients not only have to wait in line for capacity, they also have to accept annual price hikes of up to 15%. SiS is the economic rent of the AI era. Anyone who wants to play the AI game must pay TSMC its due. With such rock-solid fundamentals, why did US stocks tumble in June 2026? Can't Wall LSTR etc. this? The problem lies elsewhere. Crowded trades and delve rag in financial markets. Herein lies a bizarre paradox. TSMC's fundamentals are the strongest in the AI industry, yet its very weight in the stock market has become the powder keg for volatility. With TSMC's ADR nearly doubling over the past year, it has become a staple in almost every active tech fund. However, our global mutual funds have strict single-stock concentration limits, typically capped at 10%. The more TSMC's stock rises, the more portfolio managers are forced to sell to comply with risk controls. SiS creates a vicious cycle. Everyone is bullish on it, but because it has rallied so strongly, they are forced to dump it. The 5th of June sell-off was precisely the culmination of this crowded positioning, amplified by macro headwinds. In traditional logic, a dashed rate cut expectation spells trouble for tech stocks, but this time, a peculiar divergence emerged on the tape. Although NVIDIA plunged, TSMC fell far less than other chip stocks, and post-market options saw a surge in bullish bets. Why? Back as LSTRE suddenly realized whether the Fed cuts rates determines valuation multiples, but TSMC's capacity schedule determines whether the AI industry's fundamentals remain intact. As long as TSMC's fabs are running 24/7 and production lines are fully loaded, the hundreds of billions of dollars in annual AI capex from Microsoft, Google, Amazon, and others aren't being flushed down the drain. Rate cuts are sentiment. TSMC's wafers are physical proof. An even more telling signal comes from the valuation gap. TIP ICALI TSMC's ADR-US listed trades at a 20% premium to its Taiwan-listed shares thanks to greater US market liquidity. But during the June volatility, that premium shrank to a 2-year low. SIA suggests that US institutional money on Wall LSTRE is retreating due to macro jitters, while Taiwan is local capital positioned right at the front end of the supply chain, with visibility into actual wafer shipments, is aggressively buying TSMC's Taiwan-listed shares, reclaiming pricing power. The Y are casting a vote of confidence. The AI bubble narrative crumbles in the face of full capacity production. At this point, you might ask, is the CoOS bottleneck about to ease? Is TSMC building fab as in the US, Japan, and elsewhere? Why is it still not enough? The true physical limits have only just begun. Why assume that as long as TSMC expands CoOS capacity, AI chips will be abundant? That is a dangerous misconception. AI's hunger for compute is insatiable. NVIDIA's roadmap shows that the next generation Feynman architecture will require integration of even more dies, with package sizes continuing to push past the red ICLE limits. To solve this, TSMC has quietly laid the groundwork for its next-gen packaging technology, COPOS, or Pan-LabL packaging. Its IDARS liken it to aircraft carrier manufacturing inside a wafer fab. If today's CoOS packaging is like drawing on an A4 sheet of paper, COPOS is like drawing on a ping pong table. By leveraging larger square substrates, it can package many more chips in a single run, drastically reducing unit costs while boosting system performance. But every coin has two sides. While CoOS is promising, it demands extreme precision in substrate flatness and die placement. Any macroscopic wall peg, it can scrap an entire panel. That means TSMC must not only conquer atomic scale manufacturing but also tackle meter scale material science challenges. The laws of the physical world do not grant exceptions just because AI is booming. Morgan Stanley projects that cumulative global AI infrastructure investment will hit a staggering $3 trillion by 2028. SI's astronomical sum will ultimately translate into a stream of orders for TSMC. TSMC's capacity will determine whether that $3 trillion catalyzes a genuine productivity revolution or merely accumulates into a mountain of expensive inventory. As long as the physical bottleneck remains, TSMC's supremacy is unassailable. Let's run the numbers. As of June 2026, TSMC trades at roughly 21 to 25 times forward earnings. Is that high in traditional manufacturing? Yes, astronomically so. But for a company with over 30% annual revenue growth, 66% gross margins, and a 90% monopoly over the critical choke point of the AI supply chain, this valuation is not just reasonable, it carries a visible discount. The 5-led App-Haya SEM-ICONDU CTOR index trades at an average of 26 times earnings. TSMC, the anchor of that very index, is actually cheaper than the average. Geopol ATCS is forcing TSMC to diversify its manufacturing footprint. But the most advanced Core 2 nanometers and below processes remain firmly anchored in Taiwan. That is both TSMC's strategic line of defense and the fragile jugular of the global tech industry. Let us return to our original question. What was the June 2026 US stock volatility really? On the surface, it was about rate cut anxiety. At its core, it was a violent collision between virtual capital and physical reality. While LSTRE can wipe billions of NVIDIA's valuation in a single day, but it cannot accelerate the output of a single silicon wafer by even a second. NVIDIA defines the intelligence ceiling of AI. TSMC defines the physical boundary of AI. In this new era driven by silicon-based civilization, compute is the gun but the wafer is the bullet. Fails on hardcore physical manufacturing, build out of crowded trades and reflexive Del-E racking. The AI wave is still in its early innings, but only investors who truly grasp the physical bottleneck will find their anchor in this decade-long marathon.